I mean, if we go back to 2020, like, May, June, July, the calls for a housing crash were loud and consistent. I mean, just everywhere. I mean, even Ken McElroy, he has since deleted the video, but even Ken McElroy was out, housing crash. And I'm like, guys, no, it's just not coming. This is not possible. We have the best affordability. We've got rates here. And what was the problem is it was an emotional call. Alrighty, folks, we are going to talk to somebody who has had an interesting career. He came out of college, was a software engineer for a couple of years, did real estate on the side, did a couple of rent-by rooms out of the Seattle area. He then realized that he was interested in something else, and he's currently running a $20 million debt fund. It's going to be interesting to understand how he got from there to here. Let's welcome Kunal to the show. How you doing, buddy?
Good, man. Thank you for having me. I appreciate it.
Absolutely. Thank you for stopping by and saying hi at Resi Club. Shout out Lance Lambert for that New York event. It was fun to see all of the One Rental at a Time fans talk with me. I think I talked to 15 or 20 people. It was a lot of fun.
Oh, nice.
Nice.
Yeah, pretty much like 30% of the reason I showed up to that event was to say hi to you. So no offense to Lance. The other 70% that was for him, but
there you go. I got 30. I'll take that. I'll take that. Yeah. Well, I did. I tried to kind of intro you to the group. Why don't you do that yourself? Who is Kunal? What are you all about? What are you doing? What you've done? Give us your kind of resume of real estate.
Yeah, sure. So I'll try to not make the story super long, but kind of the reason I wanted to I reached out to you to ask you to do this interview is kind of I wanted to give back to the community. So yeah, Michael, you probably single-handedly kind of altered the trajectory of my life, and I'll get to how you did that. Wow. But yeah, try to make the story not super long. Back when I was in college, I was studying computer science. I knew I was going to be a software engineer, but I also knew I didn't want to do that forever. Like I always kind of had an entrepreneurial itch, even though to be honest, I think I'm relatively lazy. So I didn't have when I was in middle school, I was like, oh, I want to do a startup or something like that. And then I got older and I was like, that's a lot of work. I don't know. Yeah. So I was finding other things to do. And I kind of stumbled across the Bigger Pockets podcast. So at the time I didn't know real estate was a thing that a lot of people did. It just seemed like something that oh, maybe that's just what old people do when they retire. They just stick their money into some houses or something. I had no idea. Right. But I started listening to the podcast and I was like, oh yeah, this is actually really interesting. There's actually a lot of stuff going on here that I didn't realize. So I graduated in 2020. So that was during the middle of the pandemic. So I had signed my return offer to return to work at Facebook in Seattle. And so I knew I was going to move up there eventually, but I had no idea what the timeline was looking like. I don't know if the offer would fall through, or that was kind of a time of confusion for me. So that summer, I didn't have anything to do. I was just at home. So I literally just would go on a walk in my neighborhood, put on the podcast, and just listen for a couple hours. So I think I literally listened to maybe 300-400 episodes of Bigger Pockets in that one summer. Wow. And so kind of the framework I developed through listening to all this content, I think one important lesson I took away from that was there are kind of two ways to scale. One is to do everything yourself, go very slowly. Obviously, nothing wrong with that. Number one rental at a time, obviously. And if you want to move a little more quickly, I think what I kind of realized was, I think an easy way to do that is to find somebody who's already where you want to be and who's doing what you want to do, and then just try to provide them value somehow and give them a reason to help you out. So I was listening to one podcast episode that summer, and the guest was talking about how she made $1 million on one flip in Seattle. And I was like, I didn't know, at that point, I was like, I didn't know you could make this kind of money in real estate, man. That's crazy. So
that's crazy.
Yeah. And I knew I was moving up there. So I actually sat down and thought about it. And I was like, how can I provide this person value? And so what I decided to do was I used my computer science background. So I wrote a bot that scrapes Redfin and Zillow for deals that fit her criteria that she talked about on the podcast. And anytime a new listing would come online that fit some broad criteria, it would just automatically run the numbers on it at a very high level, nothing super crazy. And then it would actually send her an email that hey, this deal might be a good fit. Here's the numbers. And I just cold messaged her and I said, hey, I heard you on the podcast. I built this for you. Let me know if this is useful. Also, I'm moving to Seattle soon. So if you're open to it, let's get coffee.
Yeah.
So I didn't hear back for like a week or two, and then finally she responded, and she's like, "Hey, like, I got a lot of messages after that podcast, but nobody's ever done something like this for me before. So let's meet up."
Yeah.
So then when I moved up to Seattle, I was like, okay, I want to get into real estate. I think long term, I want to scale up and do like a fund or something larger. But in the meantime, I'm happy to start buying up my own properties and get some experience myself. So she introduced me to a brokerage that helped real estate investors. I got a very investor friendly agent.
Mm-hmm.
I bought a couple of rent by rooms in the Seattle area. So I kind of connected with Todd Baldwin a little bit, and that's how I found your channel actually. So I did that. I helped her out with an apartment syndication because I wanted to learn how that kind of business works. So I did some investor relations for that. And then she actually introduced me to my current business partner, who's the CEO of this mortgage company. And he was spinning up this debt fund on the side for his own personal, just like as a side project. And he didn't want to run the fund himself. So she actually introduced me to him. And she's like, hey, like Kunal ran the whole like investor relations side, the investor portal, whatever, like you guys should connect. And so I connected with him. And I kind of started doing that maybe 6 months before I quit software engineering. So we were doing that for a while. And then we had a third partner who was in charge of fundraising, and he stepped back and he's like, hey, I have my own business. Like, this is taking a lot of time. I don't want to do this anymore. And I just told my other business partners, like, hey, I want to do this full time. Like, I'll pick up everything. And then, yeah, I've been kind of running with that ever since. That's how I kind of got to where I am. So at the time I took over, the fund had around 2 million in it. And yeah, we just crossed 23 million last month. So it's
very cool
journey, but yeah.
Very cool. There's so much in that we can kind of pull back and kind of go a little deeper on. The first one I want to go to is, do you want to name this person on Bigger Pockets podcast that you connected with? What's her name?
Yeah, her name is Leica.
Leica.
Yeah.
Okay. All right.
So I think she was the MC of the BP Con this year or something like that. So she, yeah. If you heard the name before, that might be where. But yeah.
Yeah, there you go. So Leica, shout out if you ever see this or someone you know sees this. Congratulations, you made a difference. You made a difference. That's awesome. I want to pull on that thread about adding value, right? Bigger Pockets, obviously a monster podcast. I've been on, nothing quite that large. I've been on, Ryan Pineda's and Meet Kevin and, Iced Coffee Hour and things of that nature. And you get a lot of cold DMs, a lot.
Mm-hmm.
And most of them are something like, hey, let me take you to coffee. I mean, literally that's the message.
Mm-hmm.
So those undoubtedly get ignored, deleted. But I got to tell you, as someone, who gets a lot of messages, having somebody build something for you with the criteria that you had in the podcast and just kind of like, hey, I built this for you. Let me know what you think. That's different. And, adding value, like standing out from the crowd is not hard, but so few people do it. So few people go, oh, Michael, great podcast on Iced Coffee Hour. You really changed my life. Can I take you to coffee? And they feel like they've done something without realizing I might get 100, 200, 500 of those messages. You got to stand out. So good work.
Thank you. Yeah. Well, one specific point I'll add to that as well is like when you're adding value, I think some people might make the mistake of like asking the person like, oh, like, how can I help or something like that. I think that's also not that great either.
No.
You're kind of putting the burden on the person to kind of figure out like what to do. So I think, yeah, if you really want to make it work well, you got to find a very specific thing that you can help them with and just
take a shot.
Yeah.
Again, you're absolutely right. Don't put it on me to tell. No, it's really easy to hit the delete button. And if you get annoying, I hit the block button. I mean, it's just crazy. Well, let's go back early in your career. So again, you moved to Seattle, you do a couple of rent by rooms. What was the first deal? I always like to hear about the first deal.
Yeah. So that one was a pretty fun one. So to back up, why rent by room, right? So in Seattle, it's a very expensive market. And to be honest, I like expensive markets because I like, in my opinion, long-term wealth is built through the appreciation. But I was kind of juggled between building long-term wealth and also obviously need cash flow, as you say. And I mean, there's no point in having appreciation if you can't pay your mortgage. So you definitely want that cash
bad
flow
idea. Bad idea. You don't want to lose the property, people.
Yeah. So I like, again, through, I think I heard Todd Baldwin on some podcast and I was like, oh, this is a really smart idea. So that's kind of where I got the motivation to do it. So yeah, the first deal that was in a suburb south of Seattle called Renton.
Okay.
And so that one was a pretty interesting deal because at that point I'd only been working full time out of college for maybe like 2-3 months. And so at that point, like because of like the way my tax return, like I only had 3 months of income, like I actually qualified for a down payment assistance as well on that deal.
Oh, wow.
So it was like I think I put a little bit less than 1% down on that deal, and it was still cash flowing like $2,000 a month after all expenses. So that was a pretty fun one, and I bought that in January of 2021. So obviously we've seen a lot of appreciation since then. Sure. Depending on what model you look at, it's up around like 40 to 50% in value since then.
Put 1% down. I just want to do the. So you put, what was this, like a $700K house, 600K?
It was. I bought it for 612, and I put a little bit less than 6,000 down.
All right, so we'll just say 600 because that makes my math easier. So you put $6,000 down in 2020. It's up 50% again, easy math. So it's up 300 grand. Mm-hmm. So what is that? That's a 50x.
50x, yeah.
Yeah, I'd say wealth comes from appreciation.
Yeah.
But the key is you got to be able to hold it.
For sure.
Mm-hmm. Right, that $2,000 a month gives you that unlimited holding period. Because I'll say this: you're a young guy, but I feel pretty good about this. You will likely never see 50% appreciation in a 3-year period again. That's over. Congratulations, you got lucky. It's not coming again. But that 2K always shows up. So I'm always interested in rent by room because again, I'm looking at building a buy box in Henderson, Nevada. One of the only ways you can get cash flow today in that expensive market is rent by room. So what did you buy? Did you buy a 3, 4, 5 bedroom? What'd you buy?
Yeah, so I think when it was listed on the market, I think it was listed as a 5 bedroom, I believe. And it needed a decent amount of work. So this is kind of back when like there were crazy bidding wars and stuff. So I think this one had a decent amount of work that needed to be done. And so I think that's how I kind of wedged my way in there and still got a pretty decent deal without having to bid it up massively. So there were a couple of larger rooms in downstairs. It's a split level home. So there's a basement and then a daylight basement and an upstairs. So there were a couple of larger rooms downstairs where I was like, hey, I can just throw up a wall in the middle of this room and convert this to 2 bedrooms. So in the end, I kind of actually converted it into like a 7 bedroom. And so I just made sure the property is large enough. I added a second kitchen, a small kitchenette downstairs as well to like not have any overcrowding.
Right.
And so, yeah, that's how I kind of got that cash flow number. It's like, I think even back then when rates were at like 3-4%, I think because Seattle is still so expensive, like if you want to get like more than $1,000 of cash flow, you need to have like at least like 6-7 bedrooms.
Yeah, that was going to be my next question. A lot of the rent by room guys that I know and respect, right? They look for dead space, they call it, right, where they can create a bedroom, and it's not uncommon, to go from a 4 or 5 to a 7. So that makes total sense to me. Sounds like you did more than one, if I heard your story right.
Yeah, so that's kind of actually where you came in and kind of like helped me with my investing career, because at the time, like I was hearing a lot of conflicting information online about like, oh, there's going to be a housing crash, stuff like that. I mean, I just graduated from college, so I didn't really have any kind of experience to go off of. So I was like, oh, I mean, some of the stuff they're saying seems kind of reasonable, so maybe that is true. And then I found your channel through Todd Baldwin, and what you said, like I'm a pretty quantitative guy. Like I have a background in economics. I did a little bit of quant finance in college as well. Like I thought about going to a hedge fund for a bit. So, I mean, everything that you said made a lot more sense, and you used real numbers, and you actually called your shot in advance, and things actually came true. So I was like, okay, this guy clearly knows what he's talking about. I think a housing crash isn't coming, so let me keep buying. So I think that like you very specifically helped me out with that, because I think if I didn't find your channel, I don't know, maybe I would have stopped at one house. I don't know if I'd be where I am today. So
yeah, that's that. No, I appreciate that. I mean, if we go back to 2020, like, May, June, July, the calls for a housing crash were loud and consistent. I mean, just everywhere. I mean, even Ken McElroy, he has since deleted the video, but even Ken McElroy was out, housing crash. And I'm like, guys, no, it's just not coming. This is not possible. We have the best affordability. We've got rates here, and what was the problem was it was an emotional call. However, when you broke down the logic, looked at numbers, looked at history, it made no logical sense that we would have a housing crash. And I was a lone voice for at least a year saying, not coming, not coming. And then just to kind of play the script back, once the Fed started raising rates, right, they had that famous Jackson Hole meeting and basically said pain is coming. Even Jerome Powell at that first press meeting basically said, I'm going after housing. And again, housing crash, housing crash, housing crash. And I'm like, no, housing prices are inelastic. They don't react like stocks and crypto. What's going to happen is we are going to have a housing crash in transactions. Boy, oh boy, did I get hate. I got so much hate for that call. But again, we were right. And I even called the bottom at 3.8, million or whatever. So it's fun to be right. But man, when you make a call and make it call early, the amount of hate you get from the trolls is amazing.
I can imagine, yeah. I kind of tried following your footsteps a little bit. So I do also like to post some economic analysis on LinkedIn as well, kind of just to sharpen my thinking as well. Mm-hmm. So I do try to make some calls. I mean, even if they don't turn out to be correct, I mean, it's still a good to like build your framework for next time. So yeah, I really respect you for that.
That is important. I don't know that people realize that is why I make calls. I make calls even to this day because I'm trying to check my mental logic. Because I am making family decisions on our money with this mental model. So I'm putting it out there early. I put it out there often. And it's fun to see when you're right, obviously. But I'll tell you the truth. I learn more when I'm wrong. Like a famous call that I've made twice now and been spectacularly wrong was the recession call. Right? I made that call twice and was wrong twice. And it's interesting to kind of dig in and figure out, why you're wrong. So I appreciate that. That's a lot of fun. And I'm glad you took inputs from both sides. You did your own research and then you just kept buying. So I'm just curious, how many more did you buy after the Crash Bros started streaming Crash in 2020?
Yeah, so I bought 2 more. And so I was thinking about doing a 4th one, but I think at that point, I think rates were starting to come up a little bit too much. And so at that point, I would have had to buy maybe a 6-7 bedroom house with an ADU in the back to make the numbers work. And I was like,
right.
I think this probably doesn't really make a lot of sense. Also, we can talk a little bit more about my debt strategy at some other point, but sure. We have a strategy where we're making around 20% annualized on performing single family loans. And so there's kind of a layer of financial engineering on top of it to get it to that point. But basically I was like, if I'm making 20% on reasonably secure debt, I need to be making a lot more than that on equity to justify buying it, being in an equity position, right? So I bought 2 more houses. Both of them are pretty similar concept. The second one I actually converted into an 8-bedroom house. That one is a really interesting house. So it's zoned for single family, fully permitted, 3-level house, and for whatever reason, there's a separate kitchen on each floor. I don't know who decided to build it like that, but yeah, they listed on the market, and I was like, this is absolutely perfect for a rent by room. So there's that one, and then the last one I bought is in North Seattle. I also ended up converting that to an 8-bedroom as well. So
nice.
Kind of my plan moving forward with that is I actually moved out of Seattle. So I used to live in Seattle for 3 years. I moved to New York. Partially for fun. Also, there's a lot of capital flowing around here. So I'm trying to tap into that as well. But now that I'm across the country, I'm actually going to probably start liquidating my rentals. There's a lot of, and we can talk about this more in depth if we have time, but there's some zoning arbitrage that I see coming up in the Seattle area. And kind of the way I invest is I always want to invest if I have an edge. If I don't really have an edge, there's not really a point in actively investing. I might as well just give my money to somebody else or put in the stock market or just do something else, right? So I think there's some zoning arbitrage coming up in Seattle where I want to take advantage of that. And so
zoning arbitrage probably being around ADUs, being able to split lots, things of that nature.
Actually, no. So there's a housing bill in Washington State that passed last year where they're actually outlawing single family zoning exclusively, meaning
outlawing.
Yeah, so basically, there's some exceptions, if there's an HOA or something like that. I don't know the full extent of the exceptions, but basically, for any city in the state, they have to allow up to a duplex on any single family zone lot. Right. And in some cases, depending on the population, if it's above a certain threshold, you actually have to be able to build up to 4 units. And then in some cases, like if it's near a mass transit stop, I think like within like a half mile or a quarter mile away from that, then you can build up to 6 units.
Oh, wow.
So that's coming down the pipeline. So that bill passed the state level last year, and I think cities have until, it kind of varies city by city, but I think most of the cities are going to actually implement the changes by June of next year. And so
yeah,
kind of what my plan is, since I'm doing rent by room, like a lot of my houses already have multiple kitchens.
Sure.
All of them are like split levels. They have multiple entrances. So my plan is actually to wait for these laws to pass, get the actual details, and then actually probably convert these houses into multifamily and then sell them that way.
That's exactly what I thought you'd be doing. Yeah.
Mm-hmm.
I see that. I have a lot of friends. I don't know. I have several friends, not a lot, several friends in Seattle kind of looking at the same arbitrage, as you say. So it makes total sense. So as you sit here, you know, right on the cusp of 2025, just starting in 2023, deals down, I'm going to guess $1 million in equity from taking action, or they're close to it.
Yeah, it's about like 600. Without if I convert to multifamily and I add that in, that's probably like 200 to 300 per house. But I'm not really baking that in just yet until I get more clarity on that. But literally on my third house itself, so Seattle released their preliminary zoning changes, and that house is actually being upzoned to LR3, low rise 3, meaning I could actually build up to a 5-story apartment building on that lot. So I could literally get that lot entitled, and to sell the entitled lot to a builder without actually even building for like $2-3 million. So that in itself would be huge. But again, not counting that yet. We'll see how that works.
There you go. Well, let's switch over to a debt fund. I don't know. I think I've only talked to one other person doing a debt fund, and that was years and years ago. But so first, let's assume that nobody knows what it is. Define what it is first, then I'll ask some more questions. So what is a debt fund?
Sure. So it's just like any other, like I'm sure most people know what an apartment syndication is. There's a sponsor who's raising money, and then they use that money to buy a deal. So we're doing something similar where we're raising money, we're pooling capital together, but instead of buying an apartment building, we're buying a few mortgages. And so basically, so we pull all the capital together, all the returns and losses are socialized across everybody in the fund. So we kind of distribute risk that way. So that's one way where it's a little bit different than a syndication, where you're only buying one individual asset, versus in a fund, you're pulling it across multiple different assets.
So you're actually going out and buying the mortgage.
Yeah. So our specific strategy is pretty interesting. So as I mentioned, my business partner, he's the CEO and founder of a mortgage company. So what we do as a fund is, like, there's some other funds where they're direct lenders, where they'll get capital together and then they'll find deals to lend on. Sure. That's not what we do. So we raise money, and we have a constant source of deal flow through his mortgage company, where whenever we get more capital, we can just look at some of the loans that they've originated in the past month or so, and we can actually buy some of those mortgages. So we have a lot less cash drag by doing this, because we have more deals than money. And so specifically what we do is, the way that we get our returns higher is we actually don't buy the entire mortgage. What we do is, when the mortgage is originated, we actually split it up into 2 parts. There's an A piece, which you can call like maybe like the first 90 to 95% of the mortgage. Sure. And then the B piece, which is the remaining 5 to 10%. And so what we do as a fund is we actually come in and we only buy the B piece. And then the reason that's useful is because when you split up this loan this way, you make the B piece more junior to the A piece. So if there's a foreclosure, the A piece's returns are prioritized. And so because of that, when we sell that A piece to some other institution, credit fund, whoever else we have a contract with, they will actually take us lower interest rate. So maybe when we buy the entire mortgage, like the whole mortgage will be paying out like 10%. Right. But an A-piece buyer might be willing to buy that 95% slice for 9% instead. Right. And so when we go in and we buy that B-piece, we're actually collecting that whole spread from the A-piece, plus that full, like, maybe 10% on that slice that we own. So that's how we get our returns so high. And so obviously, like, when you're doing these kind of like things, like there's it's essentially taking leverage on debt. So you got to be very acutely aware of what kind of risks you're taking on. So when we buy these loans, we're only buying these on fix and flip loans. These are shorter term, 6 to 12 month loans, and the kinds of borrowers that we're exposing the fund to are very high credit quality. So I think our weighted average FICO score is like 768, something like that. And these are all people who run this as a business, not a hobby. So they're doing 10 plus flips a year. But the more important thing is you really want to look at the loan to value and loan to cost. So those are super important in terms of risk. So loan to cost, in case your listeners don't know, it's just like the loan balance divided by the total project cost. So in fix and flip, that would be purchase plus renovations.
Right.
And so as a lender, you want that ratio ideally to be lower, because the lower that is, the more skin in the game the borrower has at acquisition, right? So
correct.
So yeah, we're very acutely aware that our average loan to cost is 79%, which means they have like 20% skin in the game up front. And then our average loan to as-is value, which is the loan balance divided by the as-is market value of the property at acquisition, that's around 67%. So our borrowers are buying these properties at a very steep discount to market. So they already have a lot of built-in equity up front. And we're also only exposing the fund to more minor renovations. The logic, like these are not to the studs gut renovations. And the logic behind that is the more complex the renovation is, obviously the longer it'll take. So you have more market exposure risk. And then also there's more chance for something to go wrong. So if an unexpected expense comes up, like that might tank the whole deal, right? So our loan to as-is value is around 67%. Our loan to ARV, loan to after repair value, that's around like 62%. So there's not a huge difference between those two numbers, and that kind of reflects that these are not very heavy value adds.
I'm curious, was the fund around in kind of Q1 2022, Q2 2020?
That's when we started. Yeah. So for some historical context, my partner was doing this with his own personal capital since 2019. And then around like 2022 January is when he kind of like spun up the fund to open that kind of opportunity to some of his friends and family. So yeah, we started when rates were at 0. We've been operating through the Fed raising it to 5.25, and then we're still operating now when they're cutting and maybe pausing or hiking again.
Yeah, the reason I asked that question is, if you watch my channel, I talk to big players, that run it and I'm talking guys doing 40, 50 a year. And a lot of them were taking 6-figure losses. And I thought it was Q1, Q2 of 22. It might've been 23. Yeah. What year are we in? 24. Yeah. So it would have been Q1, Q2 of 23. That was very painful for flippers. I'm curious, did you guys see, a performance change, or because that was stressful for them and they were taking personal losses? I'm just curious what you may have seen. And I guess it was Q1, Q2 of 23.
Yeah. So we actually didn't really experience that much stress. And the reason for that is because the loans that we're buying are so conservative. Like I think at a 67% loan to as-is value, it's kind of tough to have a loss there. I mean, like even if you pause like midway through renovations, like you'd have to erode a lot of value to like.
You could have an equity loss, meaning my guys lose money, but it doesn't go to the debt level, right? The debt is not impaired.
Yeah, and so we've been very acutely aware of like trying to mitigate risk. So what we actually did is like we have like a profit split with our investors, and so we actually like made the profit split more favorable to our investors. I think in early 2023, and we did that in order to maintain the same returns we were giving to them, but also actually like take less risky loans. So we've been dropping that loan to value, dropping that loan to cost, because we've seen kind of active inventory building, and so we're not like super worried about that yet, but we're being preemptive about making sure we're not taking unnecessary risk.
Yeah. The other thing I'd want to ask you about if I was looking at this is, so a lot of this sounds great, but if you again watch my channel, I think there's a lot of pain building in the luxury markets and nearly no pain below the median. Do you know where kind of the average price point is in the portfolio? Is it at median, above? I mean, what are people flipping? I'm guessing most people flip expensive stuff, but I don't know.
Yeah, no, not necessarily. Our weighted average loan size in the portfolio is like around 480, I think. And so we buy nationwide. So it kind of depends market by market, but we have a lot of properties in more expensive markets, like some parts of the West Coast, also Northeast as well. So we have a reasonable, like maybe like 30-40% are in the more expensive markets. So I think that definitely will drag up that average loan balance. But I don't think it's super luxury. I wouldn't say that.
Yeah. You have any idea what your biggest loan is? We'll just go to that number. What do you think the biggest loan is?
It's kind of hard to say because we do have some larger loans, but those are all portfolio loans. Like maybe it might be a loan of like 10 houses or something. So one thing we're being very specific about is these are like single family 1 to 4 unit residential properties. And yeah, and that's very specifically done because as you've been saying for a while, like commercial real estate is a lot more interest rate sensitive. And I also personally agree with you that I think we will see some pain in commercial. So yeah, we're very specifically only lending on single family because it's much less interest rate sensitive.
Yeah, I like it. If somebody want to learn more about this or reach out to you and ask some questions, where should we send them?
Yeah, just check out my LinkedIn. I post economic analysis every once in a while, as I mentioned, and yeah, that has all my links up there. So yeah, if you want to learn more about me or reach out, add some value. Just kidding, but feel free to message me. Yeah.
Yep. Send them a note on LinkedIn. And then lastly, I don't know this, but I'll ask anyway on the record. Are you part of the school community for One Rental at a Time?
I'm not. No, I'm not yet.
Shame on you. Shame on you. You got to get in there, keep adding value, keep asking questions, but I appreciate you. Kunal, thank you for being here. Thank you for sharing your story.
Yeah. Thank you very much for having me.
You got it.